In this presentation, we will continue constructing our statement of cash flows using the direct method. What we've done so far is take our information on the left. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Side including a comparative balance sheet, a income statement, and some added information. Create our worksheet, our primary tool that we will be using to create the statement of cash flows. We ended up with this difference column. This is where we are concentrating now. We're going to find a home for all of these differences. Once we do so, we'll come up to the difference in cash, $61,900. And we've done so far with the operating activities and investing activities. We've highlighted and kind of made a nice colorful picture here as we have done so. And now we're going to go to the financing activities. So moving to the financing activities, we're basically just going to look for these last kind of items and find a home for these items as we go. So the next one's going to be here, the short-term notes payable. Now we already kind of indicating that it's going to go into financing, and you might just think, well, anything related to a note is pretty much going to be financing. But if you go through our thought process, you would say, well, what's the journal entry related to notes? When we get the note, we're going to debit cash. We're going to credit notes payable typically. Again, no income statement account involved, so it's not really an operating activity, which is kind of our default assumption usually. We didn't buy anything with a note typically if we just got cash with it, and so it's not going to be an investing activity. And you might start to think, well, what if we did buy something with it? What if we bought equipment with it and we credited the note and we debited the cash and we bought it? So wouldn't that be an investment? And you're right there, it would kind of be an investment, but note that in that case there was no cash involved. We bought a piece of equipment and financed it. There's no cash involved. So if that's the case, we're going to have to dig down in here and kind of remove it from the cash flow because there was no cash flow. We just purchased equipment with it. So just note in that case, we're going to have to fix these. Again, these accounts we'll have to dig down into. In practice, we'll kind of make the assumption based on the little information we have here. And then we'll dig back down, look at the GL, and look at the few transactions that should be related to these notes. There shouldn't be a lot of activity. There should be, we took a few loans out and we paid back interest. It's not like cash, where if we looked at the GL account for cash, it would be like, we'd be very overwhelmed because there'd be activity all over the place probably. If we look at the GL account for notes payable long-term and short-term notes payable, there shouldn't be too much activity. So we'll go back in there and look at the detail. Right now, we're just going to assume that we borrowed money or paid money for these differences. And that means that there's no income statement account, and so it's not operating. We didn't buy anything. We're financing the company. We're getting cash to finance the company. So it's not going to be investing, and therefore it's going to be a financing activity. When we pay back the interest, you might say, well, interest expense is an operating activity. But again, it's not like the primary thing. Interest expense isn't the primary part of the journal entry. The primary thing is to finance the company. And that's what the cash flow here is typically going to be. So here we go. So we're going to say that the cash went from 10,000 to 15. So it went up. And if it's a note payable, then if the note payable went up, our assumption then is that we borrowed money. We got cash. So for us, that would be a cash inflow. So we're going to say borrowed money. And I'm going to say, just like we do with all of it, negative of that number. And of course, that makes sense because I'm flipping it from a credit to a positive number because we're assuming that cash came into the company this time because we got a loan. Again, we don't know that for sure, and we're going to have to check that in practice. I would check that, but I'm not even going to go into the detail right now because I don't want to know the detail right now. We just want to finish the cash flow statement and get to this number and then check those items that we know we need to go check. So I'm going to make this just a different color to indicate that we found a home for that. So we'll make all the rest of them, how about this color here? So, and I'm just going to use the same color for the rest of them here because they shouldn't be, we should be able to find a home for them without too much complication. So without having to combine things, in other words. Okay, so then we have the long-term note payable, same argument. So here it went from 77.5 up. So you would think, again, we borrowed more money. So I'm actually going to, I know that we actually flipped it. So I'm going to use a term saying cash paid, because even though I'm here, I would assume we borrowed money, but I know we actually paid money because we financed the equipment. So I know, again, I know that this number, there's more detail than is here. We're going to have to deal with this equipment up top to deal with it. So although just from this information, I could say that it looks like we borrowed money, I'm just going to put cash paid because I know that's what actually happened. And once we make the adjustment, we will make that adjustment. I could put we borrowed money and then change the wording later, but I'm just going to put it here that says we paid cash. Again, I know that this number is wrong, but it doesn't make sense for us to break it out right now. It doesn't make sense for us to get into the detail and start breaking this out and complicating the puzzle when we could just solve this easy puzzle first to get to this number and then complicate things in a systematic way so that we can always, be more confident that we're still in balance. So I'm going to do the same thing here. I'm just going to say negative of this number, and there's that. So we'll say we found a home for that one. And then we've got common stock and paid in capital. Now these two, what we have to assume here is if those changed, and they don't change all the time because that common stock would only change if we issued stock. And that doesn't happen all the time. Stock is traded all the time on a stock exchange, but it's not always issued all the time by the company. Any new stock that's issued by the company means that basically they're looking for an investment by the owners. So this would be an investment in the owners. The only tricky thing here is that these two we're basically going to combine. Why is that? Because if we sell the stock at a par value, that means that what's the journal entry? We would get cash for whatever we could sell it for, the market price. We would credit common stock for the par value, which is some stated value, typically less than the market price. And then we would sell the difference would go to paid in capital. So these two, both the cash flows represent investment in the company. Now, this would be similar to if we're talking about like an owner who put money in the company of a sole proprietorship or partnership. In that case, the capital account would go up, and we would debit cash and credit the capital account. So if you're working on a different type of entity, just note that this would be similar to the owner putting money into the company for a capital account. And note, if you go through our questions, it's not an operating activity because there's no income statement account involved. It's not an investment activity because we're not buying anything. The company is not buying anything, or the business is not buying anything. The individual is buying part of the company and buying stock, but the company itself isn't buying anything. The company is selling its own claim to its own value, to its own future revenues and whatnot for investment, for capital, for money to finance. So that's why it's going to be a financing activity. Okay, so we're going to do the same thing over here. I'm just going to put negative of this number minus this number. Same process, which basically adds them up and makes it a positive because this is a cash inflow. Cash is going into the company. So I'm going to say we found a home for those two. And then we got the last one, which is dividends. And dividends here, again, we listed it out because we listed out all the temporary accounts so this is a temporary account. So the dividends then, it represent payment to the owners. And they're similar to like a draw for a sole proprietorship or partnership. So here we're going to say that means that cash must have gone out. It's a financing activity because what's the journal entry? It's going to be credit cash and debit dividends or retained earnings. Again, no income statement account involved, not operating. The company didn't buy or sell any asset. It's basically giving back value of the company to the owners, and that's going to be part of financing. So I'm going to put negative of this number, flipping the sign. This is an outflow here, and there we have that. So then we're going to sum this up because we found a home for everything now, and hopefully we're in balance. So we found a home for everything here. This one we found a home down here, and then everything else we found a home for. So hopefully we're in balance. I'm going to sum this up, sum up the financing activities. We can even underline it here if we want to underline. And then equals the sum of these items. And there we have that. And then if we sum up this outer column, we should get back to this number. Notice that this number is getting pulled from here. I'm going to do it now by summing up the three components: operating activities, investing activities, financing activities. So let's sum up this outer column. So I'm going to delete this, equals the sum, and double click the sum and highlight these three numbers. That minus that plus that gives us the 61.9, and that matches what we have over here. So here we have our cash flow statement is working. This number ties out to what we would have on the difference. Now that's not the ending number on the cash flow statement, because if we did that, then the people reading the statement would have to do a little work, meaning they'd have to take this comparative balance sheet we give them, take the difference between them, and figure out that the cash flow statement ties out to that if they wanted to check that. But we don't want to make them do that much work, so what we do is we tie this out. This is really what we're trying to get to, but we tie it out to ending cash. And the way we're going to do that is we're just going to list out these beginning numbers. So this is going to equal this number, the cash on the prior balance sheet, and then if we add those up, that's going to equal the 123,450, the cash on the current balance sheet. So then if someone wants to look at this, they're going to say, okay, cash on the balance sheet, that should match the cash flow bottom line number on the cash flow statement. So that's just an easy tie out. However, this is really the number we care about, because this is the change in cash. This is what actually happened, and this statement is a change statement. So now what we want to do, we found a home for all these, but we noted we're going to have some problems here. And the problems typically will happen in the investing activity and financing activity. So we know we're going to have to break out this number. So next we're going to do that systematically. We're going to have to say, okay, how can I systematically break this out without messing up the fact that my puzzle works right now? And this can get complicated, but note that what we have here is something that we have a good starting ground from. If we go somewhere else, if we go to like an instructor and say, this is where I'm at, I know exactly what the problem is, we can list out exactly where we're at instead of starting over. If we're in practice, same thing. We can say, hey, this is where we're at. I know I need to do something here. I know I'm in balance now. How do I break this out to remain in balance and whatnot? And we have a starting point to go through without just kind of starting over. So that's going to be the argument of using a method like this. For more accounting information and accounting courses, visit our website at accountinginstruction.info.